Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Dennis Dick, and we have Tim Anderson on the line. He's Managing Director at TJM Investments, calling from the floor of the New York Stock Exchange. Tim, how you doing this morning?
I'm good. How are you guys doing?
We're doing good. Well, a lot of volatility in the market last week. We did have a little bit of a rally overnight. Things are quickly fading. Going into earnings season here, how are you preparing your clients?
Well, I think there's two really big things to look at, and earnings are pretty much already set. But the conference calls and the comments from companies, you really want to look at two big questions. Well, how does $50 oil affect them? There'll obviously be some winners and some losers. And we have a much flatter yield curve over the last 4 to 6 weeks. The majority of the influence there from guidance going forward will probably be with some of the banks and the financials. In the past, the flatter yield curve has been a little bit of a precursor of an economic slowdown. And how you're going to have to listen up for comments about that also.
What are your thoughts here on the financials? Because we've got some major reports coming this week. We got J.P. Morgan and Wells on Wednesday. We got Citi and Bank of America on Thursday. And on Friday, we're going to hear from Goldman Sachs. What are your thoughts here ahead of these earnings reports?
Well, these stocks have been, underperformers until the real sharp rally that we had. The regulatory pressure on them, and it seems to have lessened up a little bit. They're still dealing with a fair amount of uncertainty over a tremendous portion of the Dodd-Frank regulations that have yet to been formalized. In terms of the flatter yield curve, obviously the big question there is going to be how do they project that that's going to affect their net interest margin? The first half of 2014, and who knows what it'll look like once we get into the middle of the year. And what kind of loan growth do they see? That's really it's really with them. It's all about their guidance and what kind of loan growth do they see coming out of businesses that you might expect would be out there looking to borrow money if we're really growing at 4%.
Tim, let's move on to the crude market and oil stocks here. Boy, oh boy, what a landslide you've had in crude, actually making a new low, a new multi-year low on the session. But you've had, a company like ExxonMobil still kind of been holding in there. It seems like they're almost immune to, to these lower prices. You think it's just waiting for another shoe to drop in these stocks before the bottom falls out, or
There's no doubt we had some divergences last week where oil made new lows right out of the chute to start the year. Made new, sold off again, very weak again this morning. But the major international oils, Exxon, Chevron, even BP, which has the most exposure to Russia, ConocoPhillips, these stocks have not have held their December lows for now. And I think that consensus seems to be that even if we're going to be in a new world of $50 oil, it's the big international majors that are in the strongest position. They're in it for the long haul. They can go borrow money. It's the smaller companies, the tertiary names that are in the higher cost, exotic, vertical horizontal land drilling, diagonal land drilling, and the real deep water companies that have the much higher cost of exploration and production. So I think if you were going to put your toe in the water, so to speak, in these names, you'd really want to focus in on the big internationals.
What about rig? When's the last time you got a buy order in rig? I mean, this thing is.
Well, you see, that's just a situation where it's yielding 17%.
Oh boy!
And it's just you just have to, if you're buying that stock today, you just have to assume that dividend is not safe. Now, if we're going to play in that space, Schlumberger is probably the name, the safer name, like the big international oils, that's in it for the long haul, that's going to survive just about anything. But Rick, I mean, anytime you see any stock, whether it's in the oil sector or some other sector that has an exorbitant yield like 15 to 20%, you just have to have a red flag come up that dividend's got to be questionable going forward.
Tim, what about the overall market here? If oil stays down below 40 or 46.55, where it's breaking down new lows here right now, or continues to go lower here, is this good or bad for the overall market? Because early last year, we saw the market rallying on the lower crude prices. And then late last year, they started selling off on the lower crude prices. This year, it seems like they're kind of ignoring crude here again. Is this or this is not good for the overall market with oil down here at 46 bucks?
Well, it's good for the overall consumer.
Definitely for the consumer.
As anyone who buys gas on a weekly basis will tell you, it's been very noticeable, and that's got to be good for the consumer. So it's got to be good for the retailers. Not that there still can't be some type of a shakeout within the retail sector. I've thought for many, many, many years, how can there be so many different retail stores? But the overall market, it's a disrupting factor. And it's a shock to the system, and it's very, very hard to identify and quantify it's hard to put a number on the winners and the losers. When oil keeps going down, you don't know how long it's going to go. People that forecast earnings and that forecast economic models, and CIOs at places that manage billions of dollars, and they want to decide how much money in bonds, how much money in stocks, how much money in cash, they're going to make an assumption somewhere along the line as to what the price of oil is. And if they can't even put a number on that within a $10 range, they can't model anything. And that just creates tremendous uncertainty. And of course, the old adage is, the market can handle bad news, it just can't stand uncertainty. And that's the real disruptive factor with oil going down and such. There's people that will say it might be going into the 20s.
Yeah, that was actually in Barron's today. There was an article, somebody
exactly,
looking at
over the weekend.
oil.
That would be there are sectors of the economy that would be very disruptive for.
Back during the financial crisis, and this was obviously something completely different, but you saw a lot of companies that were obviously over-levered, and they started having to sell everything. They started having to sell and basically throwing out the baby with the bathwater. We saw every single stock get killed. Here we've got oil prices, but if you have an institution that's really heavily levered in oil, and they got to start raising cash, do you think if we went to $20 oil, that you could start seeing other selling in other stocks just because specific institutions need to raise cash because they've been killed on their oil positions?
Well, anything is possible. I mean, I would think that everything potentially would be in play in that type of an environment, but it's interesting that you bring that up, because I do think that a lot of the selling that we saw in January, when we had the first real serious break in oil, there were a number of times there when the market was trading almost hour to hour, 15-minute bar to 15-minute bar with the price of oil. I think that a lot of selling was coming from sovereign wealth funds from countries and from parts of the world that had tremendous exposure to oil. And if oil was a big part of their revenues nationally, and they also had a sovereign wealth fund where they had equities where they had 3 to 4-fold gains over the last 5 to 6 years. I don't know this for a fact. Nobody whispered it in my ear, but I've been doing this a long time. I just assumed that there was, a lot of selling in equities coming from sovereign wealth funds around the globe that had a lot of exposure to oil also. And you can just go right down the list. Abu Dhabi, Norway. In fact, the Norge Sovereign Wealth Fund would surprise a lot of people. There's only 6 to 8 million people in that country. It's by far the largest sovereign wealth fund in the world. Clearly, they're very levered to the oil from the North Sea. I wouldn't doubt that they were a big seller of stocks as oil really started to break hard in December. You could see that again if we broke down to another level and didn't hold $50.
Hey Tim, I want to talk to you. I don't know. Were you working? Did you finish out the year on vacation, just like the rest of the world, or were you around the last couple days of the trading year?
I was around.
Do you feel any kind of change in investor sentiment, maybe from the institutional side? I mean, a lot of people discounted, the move on the 31st, also the move on the 2nd, and it just seemed like, that the mentality had changed a little bit. And there
It
was
feels a little different, doesn't it?
Yeah, it does. And coming off our third straight, V bottom basically, the October lows, the December lows, and then, the
Yep.
lows that we had when we dipped under 2000 before. I mean, is it almost like the feeling that that this technical unhealthiness is not gonna hold up, and the institutions are more willing to sell at these levels and wait for an opportunity to buy back in at lower prices.
What's interesting is that the sell-offs that we've had, we had a significant sell-off last July. That was 6 months after a year ago in January. We had a rocky start to the year. So we had our first real sell-off after that, 6 months later in July. Then we had a sell-off in October that was fairly significant. That created a V bottom. And that was 3 months after July. Then 2 months later, we had a very shorter sell-off in December, probably precipitated by the crack in oil. Now, the sell-off we had in January was only 3 weeks after that. So the sell-offs are coming on very, very shorter intervals, and they all create V bottoms. Now, I don't know if that's a function of so much of the trading being algo-driven or electronically driven. I don't really like V bottoms. I don't think it gives the market enough time to really repair the structural damage that's been done to market internals. But the sell-offs are coming at very, very shorter intervals after each other. Now, toward the end of the year in December, I think so many people we had that 2-week rally, okay, or that sharp rally after the December sell-off. In the last few days of the year, I think that there were a lot of people that maybe wanted to sell, but they didn't want to. I mean, why create a tax liability the last week of 2014 if you could wait 3 or 4 days later and sell things that had gotten to your price objective early in 2015? So I think you had a little bit of that going on, and that created some of the selling that we saw the first few days of January. But to your real question, yeah, I do feel like it's a little different right now.
Okay.
It's the buyers don't have quite the enthusiasm, and the sellers don't wait as long until they start selling again.
Okay.
It'll be very interesting to see if the early rally in the futures holds throughout the day-to-day.
Yeah, well, it's already given quite a bit back here, only trading up 3 1/4 at 203.850. We are 10 points off that pre-market high at 48 1/4. We've been on the line with Tim Anderson, Managing Director at TJM Investments, giving us a look from the floor of the New York Stock Exchange. Tim, thanks a lot. Great information, and look forward to having you on again soon.
Guys, have a great day.
Thanks, Tim.